Hi, welcome to EQD Research Global Insights for Friday, July 16th. Today, I'm going to talk about what the volatility space is saying about the second half of 2021 and why it's got me a little bit concerned. Now, I know VIX is at a relatively low level over long-term history, hovering around the 16-17 range, is below the long-term average, and relative to where we've been over the last couple of years is not really indicating a lot of fear, being the fear index and all. But take a look at this kind of term structure chart that I put together comparing VIX, the 3-month VIX, and the 6-month VIX to their long-term averages. And you can see here, VIX closed at about a point lower than its long-term average. And for long-term, I'm using 2010 through the present because that's what I have good data for all three of these indices. But the low volatility expectations end with VIX, and they've got high volatility expectations over the next 3 months and 6 months, second half of the year, with the 3-month volatility index at a little more than a point premium, and the 6-month volatility index at almost a 2-point premium. Now, in addition to just looking at them relative to their long-term average, I also looked at where these indices usually are at in mid-July, and typically they are at a discount to the long-term average. In fact, there's only been, I think, 1 year where all three of them were at a premium, and that may have been 2011, and we know what happened in August of 2011. Now, the second thing that makes me pause and go, what's going to happen to stocks? The VVIX, the VIX of VIX, 30-day volatility expectations for a 30-day forward volatility index. It's been elevated for most of 2021, elevated in 2020 as well, but the stock market's been doing well, and VIX has been coming down. So elevated VVIX really does indicate that there is some pretty good demand out there for out-of-the-money VIX call options. That's really the driver behind VVIX. So who buys out-of-the-money call options? Well, people that are worried about tail risk or worried about a big sell-off in the overall equity market that happens very quickly. And that demand has remained despite the stock market doing fairly well and experiencing low volatility for the first half of this year. And then finally, looking at the implied volatility of out-of-the-money S&P 500 put options versus near-at-the-money S&P 500 put options. That's basically how the SIBO skew index is calculated, and this thing has been elevated almost to an outlier standpoint. The chart that I'm putting in front of you right now is the high, low, and average for the SIBO skew index by month, and goodness gracious, look at June. That last bar is June. The average was very elevated, and this is a really good indication that market participants are paying up for out-of-the-money SPX put options. And demand for SPX put options, you usually do that if you are worried about or speculating on a sell-off in the equity markets. So looking at the longer dated volatility indexes, the 3-month and the 6-month volatility index, looking at the VIX of VIX, and checking in on skew, all of those indicators indicate that there's still a lot of concern in the equity markets, a lot of uncertainty going into the second half, and we'll keep an eye on all of those indicators, as well as a bunch of other ones in the volatility space, and continue to report back in this space. So, thanks for joining me for EQD Research Global Insights. If you made it this far, even if you don't agree with what I said, you still have to hit that like button. If you don't agree with it, maybe at least getting you thinking a little bit. If you've got comments about today's video, feel free to leave them in the space below. And if you want to have a more extensive conversation with me about all of this, or give me some ideas of things to talk about in this space as well, feel free to use my email address, rhodes@eqderivatives.com.